Hello and welcome to this week's FX webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you all for joining us. I hope you've all had a great week and you are ready for what I think is going to be another quite turbulent week. Now, I know it feels like I say that all the time at the moment, and I probably do, if I'm honest, but I think it's safe to say if we look back at the last couple of months, turbulent is probably the most accurate way to describe it. Now, hopefully you can all hear me. I've just had a suggestion from Helen that there is a problem with the sound. So if someone can just message through just to let me know that the sound is okay, and I will proceed. Otherwise, I will have to hold out for a second. All good, perfect, great, all good. Thank you all for replying. So yeah, I think it's safe to say it has been a turbulent few weeks, turbulent few months really, and this week is no different. So yeah, this week's no different. I think actually in many ways this week is the culmination of what's come previously. The two key topics haven't changed. The primary one from a market's perspective is naturally the US trade talks with China. The one more domestically for myself is Brexit, and both of these is going to remain the case this week. This week, for example, we are continuing to see trade talks between the US and China. Vice Premier, the Chinese Vice Premier is visiting the US this week on Wednesday and Thursday for high-level discussions. There was speculation last week that a preliminary meeting, a preparatory meeting between the two countries was cancelled. This was denied by Larry Kudlow, but the markets really didn't take the denial, maybe took it with a pinch of salt. They seem to be reading into this that talks would maybe hit a bit of a stumbling block. Now, like I say, Kudlow denied it, and then this was followed a day or two later by a person whose name I have forgotten currently, but it will come back to me. Wilbur Ross, that's the one. So Wilbur Ross, a couple of days later, suggested that there was still a very long way from an actual agreement. Now, this comes a few weeks after Trump suggested they were going very well. The Chinese Foreign Ministry suggested the talks were going very well. So for Wilbur Ross to now come out and really stress how far away they were from a deal is a little bit discouraging, especially following those rumors that we heard earlier in the week. Now, this week has started with charges being brought against Huawei. This is a Chinese technology giant in the telecommunications space. The significance of this will depend on how the next few weeks really pan out, I guess. Firstly, the US case against Huawei is not new, so it's not surprising. But the timing of it is curious at best. We will only know further down the line what significance this is playing in the trade war, if any, or whether this is nothing more than a coincidence, which I'm struggling to see at this moment in time. Whether this is the US putting pressure on a major Chinese firm, a champion of Chinese industry that is expanding rapidly around the world, wants to be the largest phone maker, for example, globally. Whether this is the US putting pressure on this company in order to, as a display of strength, to force China into concessions and show what it can do when the two sides are not when the two countries are not on the same side, or whether this is seen as a bargaining chip potentially for the Trump administration, where they bring charges now and they offer to reduce any charges or any penalties later on as part of the negotiation. We'll have to wait and see. This wouldn't be the first time we've seen that kind of tactic, or we've appeared to see that tactic employed. We'll remember that only a few months ago we were seeing similar. A similar situation that created a similar amount of speculation, shall we say. The flip side of this is that it really ratchets up trade, the tensions between the two countries at a time when people in the markets were hoping that we would see some form of progress. So I think this is all negotiating tactics, and we will see just how this pans out over the next week or two. The talks on Wednesday and Thursday are going to be very closely watched now. They would have been anyway, I guess, and we'll see how they do pan out. And then also this week we do have things like the Fed meeting on Wednesday. I expect a bit of a more, and we'll see this on the economic calendar. Actually, you can see on the screen right now, we've got MarketPulse. That's where we upload all our commentary, myself and the other analysts in the organization from across the globe. And this is where you'll also access the economic calendar. Now, I typically just choose countries that influence the currency pairs which we use for this particular webinar. So you can see that I'm highlighting them right now: Spain, UK, and US. And then I just tend to focus on medium and upper tier just to drown out the noise. So like I said, Wednesday we have the FOMC meeting. I don't think we're expecting too much from it. We've seen a far more dovish approach taken by the central bank in recent weeks and recent months, really. Gradually, as the economy has slowed, as the headwinds have piled up, as global growth forecasts have been lowered, as market turbulence has forced an inversion of the yield curve, which has concerned investors about the potential and what this means, the signals that this sends about potential for risk, for recessions, or at least interest rate cuts further down the road. We've seen the Fed raise interest rates 4 times in 2018 and reduce their expectations for 2019 to around 2 or 3. Markets currently pricing in 0 at the last time of checking, and we can see this on CME Group, the Fed Watch tool, which I think I will have shown you all in a previous session. And really, we're just going to get, I expect we're just going to get confirmation of these new views now on Wednesday. They may try and talk up the prospects for the economy throughout this year while remaining patient on interest rates, and I think patient is going to be the key word there. We will see a press conference with Jay Powell because he wanted to ensure that investors viewed all events as live now. We remember that the Fed used to only hold press conferences prior to this year after any meeting where we had new economic projections. So people were discounting the other meetings as being non-live meetings, so meetings where the Fed were not going to raise interest rates. Jay Powell sought to change that. He wanted all meetings to be taken live now without economic projections until we get that first rate hike at a meeting that doesn't have economic projections. I don't think the mentality is going to change, but it does offer us further transparency at the Fed. As I say, if we look at December this year, markets are pricing in a 73% chance that interest rates are unchanged from where they currently are. So still not on board with the Fed. The Fed has come more in line. I might expect markets to move more in line with the Fed as the year goes on. I don't envisage a year of no interest rate hikes after a year of 4, but then I didn't believe that it was correct for the Fed to raise interest rates in December. I thought they could quite easily held off. So I think 1 to 2 is probably more accurate this year, but markets do respond to current events and current news and reports, and that's what we're seeing now. So that's the Fed on Wednesday. We also have the jobs report on Friday. This jobs report is going to be heavily impacted by the US government shutdown, which ended at the weekend, which could restart again in 3 weeks because we've only had a temporary funding bill signed off. So we could be looking at this situation again in a few weeks' time. My gut instinct would suggest that every effort is going to be made to avoid it, particularly on the Republican side. I don't believe that Trump would have called an end to the shutdown if he didn't believe it was doing himself and the Republicans, primarily himself, more damage than it was doing to the Democrats. I don't think this was a gesture of goodwill, for example, to the furloughed workers and for those going without pay. I very much think this is a case of the polls are suggesting he was being damaged politically, that Trump primarily was being seen to be to blame for the shutdown, and therefore he decided a different approach was needed. There may be a case that he may choose to run a PR battle and shut down the government again and try to go on the offensive this time and ensure and make new efforts to push the blame onto the Democrats and see if that would be more successful. The idea being that they would own the next shutdown after he owned the last. I think it was a massive PR blunder when he was effectively goaded into owning the shutdown following discussions on camera with Chuck Schumer and Nancy Pelosi. And I think it was always going to be an uphill struggle from there. But what that means is the jobs report on Friday is going to be interesting. It is going to likely to be impacted. We'll see the full effects of it here. But I think we're looking at a jobs figure in the region of 168,000. Anything up to 200,000, I think, is what people are really expecting. But if we do see a number outside the ordinary, and we should expect it to be a strong possibility under the circumstances, we may see an overreaction immediately, but people, again, will be immediately wanting to know how much of an impact the shutdown played, how much of that impact is permanent, and how much of it's temporary. Earnings shouldn't be overly impacted. Unemployment could actually tick higher with the furloughed workers potentially or probably being counting as unemployed at the date that the data was collected. So if this jumps up to 4%, for example, I wouldn't be too surprised here, but then you would expect it therefore to drop back a month later, assuming we don't have another shutdown. What that means is I expect there could be a lot of volatility around this event while people try to work out what the data means, how much of it's shutdown related, how much of it's permanent, and how much of it is actually non-shutdown related. So something new to be aware of in what is already typically quite a volatile report. The other one, the other event this week is Brexit. Now, I don't want to go too much into today's vote. So today's Tuesday, the 29th of January. We have a vote in Parliament on Theresa May's Plan B. That comes with a bunch of amendments which are being tabled to the Speaker, who just prior to the start of this webinar, I believe the Speaker, John Bercow of the House of Commons, was going to announce which of the tabled amendments was going to be accepted and voted on in Parliament. These amendments vary quite significantly from across the board, from those pushing for an extension to Article 50 if no deal is agreed by the end of February, all the way to the backstop being replaced with a commitment to alternative arrangements. That was an offer pushed by the Brexiteer side and supported by Theresa May. It was announced this morning. At this moment in time, it's hard to see which ones are going to be pushed through. It seems that as the day goes on, we're seeing more suggestions appear. The ERG, the European Research Group, who is spearheaded by Jacob Rees-Mogg, has tabled an alternative plan, which would include amending 4 parts of Theresa May's plan, obviously including the backstop. That's likely to attract a lot of attention today. The chances are we will see Theresa May return to Brussels over the course of the next week and try to get these concessions. And I'm still doubtful that the EU will accept any amendments unless it means a softer Brexit, because the incentivization is just not there. The UK doesn't hold the cards now. It doesn't have the leverage. The leverage that the UK had was no deal. But this is so widely opposed in Parliament now that it's very much weakened the UK's hand in all of this, and efforts are constantly being made to further that. And that's why we've seen the pound do so well as well over the last few weeks. So we'll see how that goes today, and then I imagine it's going to be another week of negotiations, chat, market reporting, and but actually very slow momentum on this front. Outside of this, like I say, there's still plenty to latch onto this week. We've got the parliamentary vote today. We've got little bits of data being released, things like ADP. You've got a lot of US economic data being released, delayed because of the US government shutdown. We've got things like manufacturing PMIs from China and non-manufacturing PMIs, with GDP data from the Euro area, which of course is experiencing a slowdown right now, which forced Mario Draghi to almost concede that that the risks have materialized to the downside. That was on Thursday. I think markets, while they didn't actually revise down expectations for an interest rate hike this year, I think that will come in March when they release their new economic projections, and they effectively laid the groundwork for that. And also the mention of LTROs, the financing for financial institutions, was mentioned as well. So I think the ECB is going to have to be very flexible over the next few meetings. We could see LTROs announced, and I think we are going to see the rate hike when the next economic projections are announced at the next meeting in March will be pushed back into 2020, which means Draghi will end this 8-year term without ever having raised interest rates, with his predecessor, Jean-Claude Trichet, having cut interest rates at his last meeting back in 2011, having raised interest rates, at his last meeting back in 2011, something Draghi had to quickly reverse. As I say, plenty of economic data being released, manufacturing PMIs then on Friday. It's hard to see why I think it's going to be a volatile week, let's put it that way. So with that, let's have a look at some charts. Now, we're going to use the usual charts. This isn't a Brexit specific webinar like last week, and this is not a monthly review, so we're just going to go through the normal currency pairs. If you've got any questions, please do shout up. Just ask any questions away, and I'll try to answer as we go. Euro dollar, we haven't really seen much change, and I know we have seen this rebound. Now, this is encouraging from a bullish perspective. We had this not floor, but 113 is clearly a solid area of support. We have briefly bounced below here on a couple of occasions, but those moves have been quickly reversed. This was a larger movement to the downside, but again, it was only a couple of days before we were back in that previous range. 113 remains a solid support as far as I'm concerned, and the fact that we've got this this bullish engulfing pattern here with the price close on Friday closing above Thursday's open, and these are nice long candles as well, which does just add to that. This is quite a bullish signal for me. Now, the first test comes around these kind of 114.50s. You can see that throughout this period, this has been a level of support and resistance. We did break over above here on a couple of occasions, though, so it's not overly significant. But I think a break above here then puts this kind of 115 to 115.50 zone into view. Again, prior zone of support and resistance. Really, I want to see a break above 116 if I'm going to become more bullish on this. Then we've seen the fibs levels taken out. We're seeing the 200 and 233 day simple moving average come under pressure, and we've got new highs as well. So that's ultimately the bullish, the really bullish signal on here, that we've broken out of this longer term trading range. But for now, we're just looking for the little signs along the way. And like I said, the next test now is 114.50, with 115, 115.50 just above there, providing the next test, and 113 remains a major level of support to the downside. Cable remains susceptible to Brexit, so we have to be aware of that when looking at these charts. These things can quickly reverse, and the charts can give us indications on people's current thoughts and views on this particular pair, and more importantly on the pound. But that can change, and very quickly, because the situation is constantly moving. It's very fluid. But at this moment in time, people are far more bullish, and as I said earlier, people are more bullish on the pound because the prospects of no deal Brexit are being diminished, albeit with elements of Parliament undermining Theresa May's attempts to negotiate a deal with the EU, which is already very unpopular because of the backstop. There is widespread support for no deal, for blocking no deal Brexit, or for no deal Brexit never materialising in Parliament. And I think Theresa May really supports this, but she can't be seen to because it's part of her negotiating hand. But with the efforts being made to prevent it, this gives upside to the pound, because a lot of the downside in the pound was related to no deal risk. And what we've seen over the last week is really interesting, because we've seen a breakthrough kind of these 130s. That's a big psychological level. Failed at the first time of asking, rotated up. We saw it break through that falling trend line, which again was further confirmation of the break. We've entered into the 233-day simple moving average zone. We've run into resistance on the 33, on the 233, and we are pairing these gains now. But we haven't even come back to the 130-50 levels at the 200 moving average, and already it seems like we're finding some support. This still looks really bullish for me, and granted it can change quickly, but momentum is very much with the move. Starting to lag a little bit on the stochastic, worth noting. 133 is the big test here, though, because if you look back for the second half of 2018, this was resistance all along that way. That's a big test for me, but really a breakthrough the 233-day move, simple moving average band, and that's looking bullish into that one, very bullish into that 133, and that 133 is looking very susceptible. But having said that, I think the current levels are looking very susceptible as well, because of what has preceded this and because momentum is very much with the bulls. The same message can be seen in euro sterling. We're back at the bottom of the trading range. We've talked about this previously. We had the double top pattern form here, triple top even. We had that break lower. That price projection was hit here. I think it was around the 87.50s, 87.70s. We saw a bit of a correction back into 88.60, 88.65, and we've rotated lower back in the bottom of the trading range. People are always looking for specific levels to keep an eye on for support. It's not really that important to me. I'm more interested in zones. I'd previously highlighted this zone around 86.50 through 87, but really the ultimate low was one that had to be considered as well. And we've come back to that ultimate low around 86, and we are rebounding higher. Now, pressure still looks like it's with the bears here. We're seeing a weak euro right now generally, but we had them for some time, and the Brexit talks are progressing in a way that's sterling favourable. Whether that's enough at this moment in time to actually break that support, that long-term support, and we are talking about support that goes back to the middle of 2017, I'm not necessarily sure. That really depends. That could depend on how today goes, being that if with the, I think it's the Cooper amendment, which calls for an extension to Article 50 if no deal is agreed, as in a deal hasn't been agreed by the end of February in Parliament, then they have to request an extension by up to 9 months. If something like that passes through today, then that could be seen as a sterling positive move, because again, it reduces the possibility of a no-deal Brexit. And it seems that there is a lot of support from that within Labour, for example, the opposition party. Then that could put more pressure on this downside. So that would be something, but then obviously that's something that the EU would have to sign off as well. I think that is something that they would sign off on. And if that breaks below, then this suddenly looks very, very bearish, because we are breaking through long-term support, and we start to see the case for the bullish pound to materialize, because once we start to see no deal off the table, then it's a case of which version of a soft Brexit looks most likely. There has been one, like I say, the changes to Theresa May's deal, which has been details released today. The confusing thing about that is the timing. So late in the day to be releasing something which they claim the EU was open to last year. There's something doesn't smell quite right with that, but we'll see how that. Again, this is a story that's only been released today, so we have to see what the EU's response to that is going to be. But like I say, this looks bearish right now. We are holding around these lows. We've rebounded off kind of this previous area of resistance here around these kind of 87s. If this breaks around 86, then I think this could start to look very bearish indeed. If not, if we see a higher low being made here, then there is potential for a correction, which again, 87 is the first line of resistance here, 87.50 after that, and then 88. Sounds like obvious levels, but sometimes these do move. The big levels, the obvious levels, are the ones that the market's just paying attention to. There's no point in arguing. The story released today, so it's the story I mentioned earlier, the European Research Group, the Brexiteer group, headed by Jacob Rees-Mogg, releasing their alternative to Theresa May's Brexit deal. Primarily the same in its makeup, but with 4 key changes, one of which is the backstop. A few other key changes as well, which I'm not necessarily sure the EU will be entirely on board with. And it's also vague from what I read, in its alternative to the backstop plan and the arrangements on the Irish border. We'll see what the European response to it will be. Steve Baker, who tweeted the story, who tweeted the actual deal out, so you can check him out on Twitter, Steve Baker, suggested that it may not be something that the EU will own up currently to having been on board with because they prefer Theresa May's deal. Again, that strikes me as being as a bit fishy, if I'm honest. Why would they not agree? Why would they not be? Why would they not support something that they agreed to in the past? Granted, if they feel like they've got a better deal now, then that's all well and good. But the EU, throughout this entire process, has been very committed to its own red lines. And if this deal was within their red lines and this deal had more chance of getting through the UK Parliament, I'm not entirely sure why the EU would oppose it publicly. So, again, we'll see how that does materialise. Aussie dollar, I've opened up a new channel here. We had this channel going down here, which we broke above previously, so there's not really any reason for it to be on the chart. But what I have done is I've added a new channel with the bottom of the channel effectively being the top of the previous channel and then stretching it out. Because the reason being that when you stretch it out and add the fresh point as the previous high up here, then it gives a new potential resistance zone of here, which is where we've now run into resistance, coming in around those 72 levels. So there's two ways that we can look at that. Look at this, sorry. One is that we are potentially back in a downward trend here, and that any bounce that we saw in the Aussie was short-lived in that 74. I was saying at the time I was really hoping we'd see kind of 75s at least. They didn't quite materialize at the time. The flip side of that could be that this risk-off period into the end of the year was quite devastating for this pair. Aussie, obviously being a beta currency, tends to perform better during times when risk appetite is strong. The flip side of that is if we see a breakthrough that falling trend line through the top of the channel, and that could be the next another bullish signal, and potentially the scope for some upside is still there. I'm still feeling positive. I must say, like, we've got a support zone here around 70 through 71. I'm not just hanging on to a bullish view for the hell of it, but there is something about this chart, and it coincides again with my more bearish view on the US dollar currently. We are seeing risk appetite gradually return in the markets overall. And I just feel like this is a chart which is showing signs of bullish behavior forming. If we break through 70 again, then I think I'll just concede on this one and accept that we're not yet seeing that rebound higher. But at the moment it's holding. And as long as that holds, I personally feel like there's potentially more chance of a break above than there is below. But again, we'll see how that goes. Interesting chart, undoubtedly. Dollar cards, it's messy. As I've said previously, I've got mixed emotions about this. So it looks really messy, but worth noting that the two blue lines we've got here are just long-term support and resistance, and it's a zone here between 132 and 132.50. The reason why I've left them on is because that's the zone we're currently in. It coincides with the 55.89 moving average band, which is currently holding, as well as the 50 fib, somewhere in the 50 to 61.8 fib zone. Basically, what I'm looking for here is if we break below that 61.8 fib, which means we've broken long-term support and resistance, which means we've broken key moving average levels, and we've broken fib and potentially a rising channel, and potentially again the 202.33, then all of a sudden this starts to look very bearish. I think that's probably what I'd like to see, because it would confirm my bearish US dollar viewpoint. But these two economies are closely linked. Canadian dollar can be influenced by movements in oil, and obviously oil hasn't yet broken higher significantly. We are obviously up 25% from the Christmas lows, but I feel like there's potentially more to go. And we did drop to very low levels in the run up to that, which is why we did see this run into Christmas being so weak for the Canadian. One of the reasons why we saw the run into Christmas being was so weak for the Canadian dollar. I feel like if we make that next jump in oil, then that could be the catalyst for this break below here. But we just have to may have to wait a little bit longer for that. We're still in that 55.8 now moving average band. As that continues to climb, price could continue to gradually move higher as well. But I'm just not seeing that upside momentum form that's making me doubt my view that this could at some point break lower. It's just more of a waiting game. Sterling CAD's just messy, but we're just in a very gradual climb here. Canadian dollar, like I say, since the turn of the year, performing better as a result of the oil movements, but the pound obviously performing better because of the way Brexit is materializing. If we see a breakout, we are seeing it selling into these breakouts recently. But this just looks bullish right now for me, just like it does with many of the pound pairs. Yes, we're seeing it sold into, but we're not seeing it drop either. The bigger challenge to the upside will come again if we do see a break higher in oil. But prior to that, there's no reason why we couldn't see some upside in the meantime. At the moment, though, it's still very much in that channel. And again, not, in my view, among the more interesting charts. Kiwi Dollars almost frustrating me like Aussie now. I feel like there's potential for more upside here. We hit 70 before correcting lower. We corrected below the 61.8 fib on this point, but that was a very exacerbated move lower. We're dragging our feet. The 200-233 day simple moving average band is holding, and we sold into it now back here when we broke above and held below, and that's exactly what we've done this time. But I'm still feeling the upward momentum. I think if we can break above the 200-233 day simple moving average, then this could really gather some momentum to the upside. I think the 50 fib would then come under a lot of pressure in the 70 level, and then 70-50 after that will be very interesting. But I think it's just dragging its feet at this moment in time. Let's start with dollar yen just to keep it in the normal order. Dollar yen, we did break higher. Again, improved risk appetite, taking some of the heat off, taking some of the yen attractiveness away. We broke through that triangle area, which is what I highlighted in a previous webinar, so we can now move there. I was saying at the time, the thing with triangles is it doesn't give any directional bias. So while some may view this as we saw a big sell-off here and then a triangle form, well, that must be bearish because the momentum is to the downside. That's more viewed as being the case with a flag formation where we have two rising highs and rising lows, or with rising wedge formations where you have rising lows at a much faster pace than the lower highs, which creates a kind of wedge formation. But when you've got a triangle, which tends to have a broader opening and it tends to be more even to the upside and the downside, that tends to indicate no directional bias. And in this case, it gave us a break to the upside. We've run into resistance around 110. That's holding for now, but this one of the few dollar pairs which I think actually looks a little bit bullish. If we break through 110, then we've got this cloud formation which looks a bit flimsy because we had the break lower here. So there is potential for this to be a risk here for a break higher. You see the moving averages kind of coincide here around the kind of 111. So that becomes an interesting level for me around the kind of 111 area where the two moving average bands coincide, and also potentially as well the Ichimoku cloud as here. A breakthrough there then brings 112 and 113, 114. Again, one of those charts where it just happens to be that the big round numbers have previously been and are looking again like the more interesting levels. Sterling yen continues to look bullish. We broke through resistance here, which was resistance throughout the third quarter last year. That now will be a potential level of support around the kind of 142.50s, there or thereabouts, as I've mentioned on previous resistance, potential resistance, I think around 146. We've got the 200-233 day simple moving average band. We've got the Ichimoku cloud. We're now back in that we are currently trading within. If we break through that kind of 146, then this starts to look very bullish indeed, not just because we've taken out moving averages, Ichimoku, but that would suggest that a lagging line is going through the Ichimoku as well. So that would be the bullish confirmation as well. Sunil asking if I've pronounced that right. If I've not, apologies. The two red moving average values. So they're 200 day simple moving average and 233. Not conventional, the 233. But I use a Fibonacci in a lot of my charting, and a long time ago I decided to see if how handy and how useful it is for my moving averages. and I found 55.89 as a band and 200.233 as a band to be quite interesting levels in many cases. Kind of works in the same way that an Ichimoku cloud does. So rather than looking for very specific rotation points or levels of support and resistance, it creates it as more of a band, and it just resonates with me personally. It's not for everyone, but for me, I find them quite useful. Not necessarily on this chart, if I'm perfectly honest, if you look back, but on other charts, very much so. I use them on the Ichimoku charts as well, just as potential areas of interest, but I'm paying a lot more attention actually to the actual cloud itself. So yeah, that's when I'm looking at this chart, that's your key levels for me, but I still think momentum is with the bulls here. Potential for a bit of a correction again with the momentum slightly dipping on the stochastic, but I think overall momentum is to the upside with the bulls. Same with euro. Euro's not as strong as the pound right now, but we are entering resistance as we were with dollar yen around these kind of 125, 126 levels. Long-term support and resistance again. It looks like a wide band, but much like anything else, I'm not really interested in whether it's a wide band or not. I'm interested in what areas I should be concerned about if I'm a bull, or what areas could be potential rotation points if I'm a bear. That's really all we're after at the end of the day. I'm looking at this right now. We've got the sell-off. It looks more like a rising wedge, this pattern, which would typically be bearish if I'm honest. That said, we are still seeing the rising lows. From a momentum perspective, it seems to be building to the upside. So it's imperfect, but if we see a break of these like kind of late 125s, 126, then that would suggest to me this is bullish, at which point these kind of 128s start to look very interesting again with the Ichimoku cloud comes into play. And if we do see bullish move in dollar yen and sterling yen, then this would make me more bullish on the euro yen perspective. Equally, if we start to see a rotation in this kind of zone, then that could be a bearish confirmation coming around as a rotation off the actual Ichimoku cloud as well. At which point we're looking at kind of these 123.75s, 123.50s as potential support, because that's most recent support, and a breakthrough them would suggest at least that we are seeing a bit more of a corrective move to the downside. Like I say, less bullish than maybe sterling yen, but all three of them are displaying signs of potential corrective moves in the near term, especially on the stochastic indicator. So worth bearing in mind, but longer term potentially look a lot more bullish. And that's that. That's all the charts. I hope you all found that useful. If you want to watch this back, it will be on YouTube later on today, and also the MarketPulse website. Apart from that, if you got any questions that you didn't want to ask now or you didn't think of currently, you can always reach out to me on Twitter. My Twitter username is Craig_Forex. And again, apart from that, join us next week for our hour-long session with myself and our analyst over in New York, Ed Moyer. We'll be talking about the month ahead and about the key events currently. And finally, follow our new podcasts. And they're not particularly new at this point in time, but you've got the OANDA Market Insights podcast that's released every Friday covering the week's events. And you've also got OANDA Market Beat, which is released. The latest episode, I believe, has just come out, and that's released in the middle of the week. So please do check them out. And as always, give feedback. Any feedback's welcome. I'm sure nothing we offer is perfect, and it can all be improved. And any constructive feedback is always extremely welcome. I've had one more question. May I know what is the indicator used at the bottom of your chart? That's a MACD. So there's MACD and then there's stochastic, and they are both on the default parameters. Okay, if that's everything, then perfect. I wish you all the very best of luck with your trading. I hope you enjoyed today's session, and I hope to see you all again next week. Thank you very much.